Contribution margin is defined as sales less variable costs, and contribution margin ratio is sales less variable cost divided by sales, which is the percentage of dollars remaining after paying variable costs. And for this example, I'm going to assume that revenue and sales is the same thing, just to keep it simple. So a good way to think about contribution margin is whatever's left, sales less variable cost, that amount of money that's left goes to pay two things. It goes to pay fixed expenses, fixed costs, and the remainder is profit. So contribution margin, that bucket of money, goes to pay fixed costs, the remainder is profit. A good example that's in the news just today is that retail sales for the last quarter, there was a record percentage of spending that was done by the top 10% of earners. So the top 10% of wage earners, the wealthy, accounted for 49% of retail spending, and that's a record. And the problem is that we have a huge concentration of spending in a small group of people. So it's a concentrated group. The risk is if that group slows their spending, it has a huge impact on the economy. You can relate that to a business. So let's say you're a custom home builder. Your clients are mostly very wealthy people. So let's go through a contribution margin example in that scenario. Let's assume that you do $1 million in revenue, variable cost $500,000. Your contribution margin is $500,000, or as a percentage, 50% of sales. Now, let's assume that the very wealthy people slow down their spending. What happens? Well, you may be in a situation where sales decline faster than the variable cost because, for example, you have repair and maintenance on all the equipment you use to make homes. You have to keep spending that money even though sales declines. So you may see a scenario where the contribution margin declines but variable sales don't, which means that your contribution margin total goes down. So let's assume, for example, that you have a contribution margin of $500,000 paying fixed expenses of $300,000, $200,000 profit. Now let's assume the contribution margin declines. It goes down to $400,000. You still have to pay $300,000 in fixed costs by definition. Now you only have $100,000 profit. So you have two things working against you. The first is that variable costs may decline slower than sales. The second is that fixed costs don't go away. So a decline in sales has a big impact on your contribution margin and your profit because variable costs and fixed costs may not decline at the same rate, and fixed costs don't decline at all.